Welcome back. In this episode, I want to talk about how I personally invest during an arguably overvalued market. We'll look at what metrics suggest that a market is overvalued and what I look for in companies during these times. Then I want to share some interviews with an investor that I chose to study, Howard Marks, on the topic of investing during overvalued markets. Lastly, I want to look over every single holding in my portfolio and tell you if I'm personally buying, holding, or selling, and just share a few high level or key notes on each of those companies. First up, what can we look at that suggests a market is overvalued? And what do investors typically reference when they talk about an overvalued market? You may have heard some news or read some headlines in the past few months that suggest that the market is overvalued. Well, the first metric and probably the most commonly used metric is the PE ratio, or the price to earnings ratio, which pretty much just tells you how much investors are willing to pay for each dollar of a company's earnings. Or as this website explains, the PE ratio for the S&P 500 is calculated by dividing the current market price for the S&P 500 by the total earnings per share of its companies over the past 12 months. And as you can see by this chart here, this is looking at a 20-year period. It's above average. It's nothing crazy like the '08 crash or 2021, but it's definitely up there. It's above the average, and that's what investors have been pointing to recently. Next up is the Shiller P, which is a lot like the regular PE, but instead of using just 1 year's earnings, it averages earnings over the past 10 years and adjusts for inflation. This smooths out any short-term fluctuations and gives a better long-term perspective on valuation. It seems like a lot of investors like this one, but I don't really like it, and I think it's almost used to over-exaggerate the argument that the market is overvalued. I don't like it because the modern market has companies that we've never seen historically. Giant trillion-dollar companies like Nvidia, Google, Meta, Amazon, and Microsoft, who are all growing revenue and earnings above 10%, and some well above 10%, as you might know. So factoring in earnings from 10 years ago can be a little dangerous in my opinion. If you think companies can't keep up with the revenue and earnings growth, then sure, the Shiller PE indicates a high valuation. But these companies aren't expected to stop growth anytime soon. Their strong digital business models allow them to grow faster than any company has in the past and at a lower cost. And with higher growth comes a higher PE ratio. Not to mention, as they continue to integrate AI into their business, the cost of growth becomes even lower since employees work more efficiently, and even in some cases, labor is replaced by cheaper labor. The point is, these PE ratios are often used to compare the current market to previous markets, but the current market is just nothing like we've ever seen before. Next up, we have the Fear and Greed Index. As explained by CNN here, the Fear and Greed Index is a compilation of 7 different indicators that measure some aspect of stock market behavior. They are market momentum, stock price strength, stock price breadth, put and call options, junk bond demand, market volatility, and safe haven demand. The index tracks how much these individual indicators deviate from their averages compared to how much they normally diverge. The index gives each indicator equal weighting in calculating a score from 0 to 100, with 100 representing maximum greediness and 0 signaling maximum fear. This definitely isn't like a perfect indicator, but I like to come in here and look at the timeline and look for periods where we're either in extreme greed or extreme fear for extended periods of time. And you might have heard about the famous Warren Buffett quote, be fearful when others are greedy and greedy when others are fearful. So that's kind of the idea behind this one. If you have an extended period of time where the overall market is greedy, I'm going to be more cautious. And if there's an extended period of time where the market is fearful, I'm going to be more aggressive and I'll be buying more stocks. Another metric I like to look at is margin debt. And margin debt is the amount of money investors borrow from their brokerage through a margin account. Over the past year, this is up just over 28%. And if we look at a 5-year chart here, you can see that it's getting up to the same amount that we were at in 2021. Now, naturally, margin debt will grow over time as the market gets bigger. So as a percentage, it's definitely not at the same level as it was 2021, but I'm going to be keeping an eye out on this one. And if it continues to rise, that's something I'm concerned about. Because to me, that kind of signals that we're getting close to the top, and we've been doing well for a while. And now people are getting lazy and they're getting comfortable with making fast money. So they take out margin to try to make even more money. But if we see any downturn, people could start getting margin calls. And if they don't respond to those by depositing more money, their brokerage can start selling shares on their behalf. And that can create this ripple effect with stock prices going lower. And that leads into my last indicator. When your gambling uncle or friend that never talks about stocks or investing starts talking about stocks, by the time the hype and excitement has gotten to those people, it usually tells me that we're near the top. But be careful, because how close to the top are we? I don't know, and I'm not going to try to make that call. When I first got interested in the market and I started investing money in probably 2018 or maybe 2019, I was that person. I finally heard about all the money people were making and heard about stocks like Hyliion, Nikola Motors, Workhorse, Snapchat, and Tattooed Chef. The point is, I got in the market and I could have invested in pretty much anything over the next 2 or 3 years and made money. If we just look at a simple chart of the S&P 500, somewhere in summer 28, I would have started investing. Let's say I would have seen myself get in the market, some idiot talking about Hyliion and talking about companies that aren't even profitable and don't have a viable product. If I got out at that point, I would have left 20% on the table. And then COVID came around, sure, I would have been down roughly 15% or so. But let's say COVID never happened and I didn't have that dip to buy back in. If the market continued to run into 2021, I would have left more than 70% on the table. And then from the highs of 2021 to the lows of 22, the broader market was only down 20%. So if I just stayed invested from the summer of 2018 to 2022, I would still be up 30+%. And I'm probably not going to accurately time this drop. So what if at this point I'm still waiting and the market just starts going back up? When am I going to buy back in? Eventually, you just end up losing out on the massive gains. So even though these things can like signal that we're near a top, I'm not going to get out of the market, because the market can be irrational for longer than you think. I'll explain in a second what I do to prepare for the top of the market when things are arguably overvalued. So story time's over, and I think I've come a long way since then. But essentially, there's a fine line between timing the market and following your investment strategy. And when I get into my buys, holds, and sells later, you'll notice that I continue to invest even in this market, and I'm pretty much fully invested, but I try to stay reasonable around valuations and I'm not going to chase valuations. There are definitely less deals in the market, and I may even take some profits if I hold a company that is very richly valued and I don't see any growth potential in the next 2 to 3 years, but I always stay invested and I don't chase hype and stocks that could potentially make a ton of money in the future but make none right now. I certainly don't think we're anywhere near the 2021 level hype, but I am starting to see signs like those people that usually aren't very interested in the stock market start to show interest, and it feels like there's a little bit of FOMO around stocks like Tesla and Palantir and the new hot crypto, and margin debt is rising somewhat quickly. But again, I'm not trying to time the cycle, and there could still be a ton of money to be made in those stocks in the next few quarters. But by analyzing the numbers and realizing that these companies have to put up almost impossible numbers to continue to grow their share price, that allows me to make that decision that I'm not going to invest. Again, I want value for my money, and I'm okay with leaving gains on the table if I think the investment is too risky. The name of the game for me is to not bust and be able to take advantage of any short-term volatility where the market freaks out, because stock market history has shown that every dip is a massive buying opportunity if you have a long-term outlook. And that leads us into the next section of this video, where I want to show you a few videos from an investor that I chose to study. That investor is Howard Marks, who is the co-founder of a hedge fund called Oaktree Capital. He talks a lot about the idea of market cycles, and I like his way of thinking when it comes to investing during overvalued markets. The first video is called Good Investing is Inherently Contrarian. Let's take a look.
I'm a value investor. I try to figure out the intrinsic value in a situation. I like to buy if the price is low relative to the intrinsic value. I like to sell if the price is high relative to the intrinsic value. What is the main determinant of that relationship? It's emotion, psychology, investor sentiment. If people are excited and bullish and optimistic regarding to the asset, chances are its price will be above the intrinsic value. And of course, that is a source of danger, and that is a source of below par returns. But if the investors are pessimistic and unexcited and have given up on an asset, then chances are perhaps that its price is languishing low relative to the intrinsic value. And that is a source of great opportunity. So we want to buy when people are depressed and pessimistic, and we want to sell when people are optimistic and excited. The difficulty is that many people's emotions or psychology, I use the terms interchangeably and it's not easy to say why, most people's emotions fluctuate the same. We're all subject to the same influences. We all read the same headlines. We all hear the same stories on TV. We all see the same economic reports. So the things that get other people excited and positive and optimistic would tend to get us excited and positive and optimistic. So the things that force people to bid securities up and make the prices high, those same forces would tend, if permitted, to make us excited and to buy when prices are high, and depressed and to sell when prices are low. So the point is that if your thinking and your emotion is the same as everybody else's, then you cannot do the outthinking and what I call the second level thinking, which is required to act against the herd. The common word is contrarian, and to sell at high prices, which are high because other people are optimistic, and buy at low prices, which are low because other people are depressed. We have to be aggressive when people are depressed and defensive when people are excited. In other words, we have to think and feel differently from others, and that's not easy. We have to be either unemotional people, or we have to learn the importance of emotional restraint and how to do it. And these things are not easy, so most people are unable to do it. You know, there is proof that most people are optimistic at the top. And the proof is that it's a top. The proof is that the prices are higher than ever before. That can only happen if optimism predominates over pessimism. There's proof that people are depressed at the bottom. And the lowness of prices is the proof. Prices can only be that low relative to intrinsic values if most people are depressed. So we have to be excited when they're depressed, and we have to be defensive when they're excited, and it's just a hard thing to do.
Okay, in that video, he talked about the market cycles and the difficulty of doing the opposite of the market because of our emotions and psychology. The point I like from that video is that we're all subject to the same influences, and that's what creates these market cycles and goes back to the points I've been making of we start seeing that overall optimism rise and more people getting into the market. Often people that never talk about stocks or investing, and those people start making more and more money, which leads to more optimism and greed. But eventually, investments just don't offer an attractive return, or investors finally realize that the hot stock that they were invested in just doesn't have a viable product, or they didn't understand how richly valued that company was. So when things finally go bad and they see themselves lose thousands of dollars and the news are all horrible, they flock out of the market. So we're left with this market that swings from one extreme to the other, overvalued to undervalued. But in this next video, he goes more into the characteristics of each cycle and what you tend to see from investors and what to do during the different cycles. So let's take a look.
Joining us right now, we've got Howard Marks. He's the co-chairman of Oak Tree Capital, which manages over $120 billion in assets. He joins us now. Hello.
Thank you, Jen. Nice to be here.
Yeah, great to have you. So, mastering the market cycle, what is the difference between mastering the market cycle and timing the market?
I think timing the market is guessing at what's going to happen tomorrow. In my opinion, the key to mastering the market cycle is understanding where it is today. We never know what's going to happen tomorrow, and the people who think they do tend to screw up. But if we have a sense for where it is, we know something about the probability distribution of returns that we're facing, and I think that's about the best we can do.
So with regards to the future, I guess, in your most recent memo, you expressed some caution, I think, on the overall market. Can you just outline some of your thinking right now, and what are maybe the biggest red flags that you're seeing across assets?
Sure. Well, I like your use of the phrase across assets because these factors affect basically everything. When I've been doing this 50 years, and when I've seen booms, invariably they were characterized by three things: too much optimism, too little risk aversion and caution, too much money chasing too few ideas. And to some extent, those things are present today, so it's time to start thinking about caution.
Can you talk about a few areas, I suppose, where, as you call them, the 7 most dangerous words in investing are most present? And I think what's interesting is also in that most recent memo you put out last week, you know, I wouldn't say sanguine on the equity markets, but certainly not the red flag we're seeing perhaps in some debt markets.
Yeah, I think that, you know, in recent years, not a lot of money has been flowing into equities. A lot has been flowing into debt. People like the idea of having a debt instrument which is going to pay interest and then give you your money back at a point in time. They are assured by that, so that makes the money flow in. When the money flows in, that means the buyers at the auction have more money to spend, and that tends to put the prices up. And with securities, price up, future return down, safety down, risk up. So credit is an idea. I want to borrow some money. Jen says, I want 5%. You say, I'll take 4. I say, I'll take 3. You say you need a full set of covenants. You say, I don't need many covenants. I say, I'll take it without covenants. I get to make a 3% covenant-light loan, and I'm the winner of the or am I the loser? Right. That's the key. And this is a process I call the race to the bottom. I wrote a memo by that title back in February '07.
Famous memo.
And to some extent, it's happening now.
So, I mean, as you say, or you quote a lot, you know, history doesn't repeat itself, it rhymes. Right. Maybe Mark Twain said that.
Yes.
So right now you've also written that it appears that debt instruments are going to be found at ground zero when things go wrong this time. You know, we've been talking about leveraged loans. They seem like the new boogeyman on Wall Street. Yes. What do you think of them?
Well, I mean, the key for you and your viewers and everybody to understand is that there's no such thing as a good idea or a bad idea until we can talk about price. It's not what you buy, I always say, it's what you pay. So I think that leveraged loans are a great idea. They pay interest, they repay principal, they're senior in the issuers, and they are generally tied to floating rate loans so you don't have interest rate risk. All good things. At what price? And no matter how good the merits are, it's possible for things to become overpriced. When money is flowing in strongly and it is to leveraged loans, then they can become overpriced, and some are.
What's the average investor, though, to do? I mean, parts of it, I read the book and I'm like, I got to go under the desk here and move to cash.
You already have that.
No, I don't want you to go under the desk, and I don't want you to move to cash.
So, yeah, what should I do? Because it's scary sometimes when you go through this and you hear, oh my gosh, he thinks we're in this really bad time.
Let me set the scene. There are two risks in investing: the risk of losing money and the risk of missing opportunity. You can eliminate either one, but it puts you firmly in the crosshairs of the other, or you can balance the two. How should you balance them at this time? Should you worry more about losing money or worry more about missing opportunity? And I would say the former. So the point is, I'm not saying get out of the market. I'm not saying go to cash. I'm not saying this is the worst thing I've ever seen. I'm just saying I would emphasize caution to avoid losses over aggressiveness and the risk of missing out. So what does that mean? Anything you want to do in the investment business, invest in stocks, bonds, loans, mutual funds, money managers, whatever it might be, you can do it aggressively or you can do it defensively. And I think today is a time to overweight defense, not to go entirely toward defense. That means, as you say, cash, get out of the market. I'm not suggesting that. We're not doing that. I don't think anybody should do it unless they are hypersensitive to losses. But I do think that this is a time for caution.
So to go back to a hot sector, or not really a sector, stocks in the stock market, the FANG names. Last year you were writing about them and said, they may well be the winners of tomorrow. But you also said, given human nature, the best will eventually become to be overpriced, even if they have great fundamentals. So have you changed or updated your thinking on those names, or does the story really remain the same? Some of these stocks have doubled since you wrote that memo.
I wish you wouldn't say that, Miles. But, the truth of the matter is that, I mean, wasn't picky on the FANGs. I'm not an expert. We don't invest in the stock market at Oaktree. What I was saying is that the willingness of people to highly value companies, not based on their present assets, but based on their long-term potential, is indicative of optimism, faith, risk tolerance. My book is all about knowing what's going on in the market, and that is an example. That's all, just an example. Now, many of the FANGs have had some severe hiccups.
Yes,
Facebook. In the last 9 months, and if somebody owned them, and then they gap down 20%, and they lose faith and sell, that's dangerous. So the point is, you have to assess and control the risk in your portfolio.
So you like to draw this.
I do draw.
The market cycle. And I'm just wondering, have the Trump tax cuts at all changed, like, what's happening with your drawing?
Let me say one thing. Go back 2 years. There were two things everybody was sure of. Trump would lose, but if perchance he won, the market would collapse. So Trump won, and the market went up. That should convince everybody, as it has me, that we don't know what the future holds. And we don't know what's going to happen, and we don't know how the market's going to react to what happens. But as to your question, the tax cut is very stimulative. It was very popular with business, and it is causing company profits to expand. So that's good. There are two questions. Number one, no matter how good things go, they can become overpriced. Has that happened? Will that happen? And number two, since it is stimulative to an already healthy economy, it raises the risk of the economy overheating, bringing on higher inflation, causing the Fed to raise interest rates even more to cool it off, and that will hurt some indebted companies. So, the interesting thing in investing is that everything has two sides.
That's the problem, but you don't know. Like, I just want the answer.
Well,
but it doesn't seem like there are two sides to it. And then sometimes you say on one hand, on the other hand, and then sometimes you say on the third hand. So I don't know what to do.
Good. Well, then I'm communicating clearly. Charlie Munger, Warren Buffett's partner, said to me when I was completing my last book, and in time to get it in the book, he says, none of this is meant to be easy, and anybody who thinks it's easy is stupid. We're talking about making money. Everybody wants to make money. It's highly competitive. Why should it be easy?
Okay, first of all, that video is from 5 years ago, if you were wondering. But the point I'm trying to make with showing you that video is that no one can accurately predict the market cycles consistently. So when you start noticing the extreme, overvalued that is in this case, you start getting a little more cautious. And going back to the valuation point at the start of the video, that extreme is moving further and further up, in my opinion, as companies get more profitable and more efficient. So that's something to keep in mind too. Cautiousness for me looks like one, staying away from the most hyped stocks that have insanely rich valuations without the fundamentals or intrinsic value to back it up. Two, potentially selling or trimming if I see my company as overvalued and I think it's going to be hard to get any share price growth in the next 2 to 3 years. Or three, focusing on the more undervalued stocks or stocks facing short-term volatility, buying the dip and simply holding the rest. And that's what you'll see me doing with my portfolio, holding off and buying the companies that I think are closer to the overvalued extreme and really focusing in on the companies that I think are currently undervalued or are facing short-term volatility. So let's go through these holdings one by one, and I'll share my personal opinion and if I'm buying, holding, or selling. Again, this is my personal opinion and not financial advice, so do your own research. First up, we have PayPal, which currently has a forward P of roughly 18, with current growth above the market and future growth expected to increase. The management team and analysts expect high single-digit growth for PayPal going forward. This company was mismanaged for many years, but in late 2023, they got a new CEO, Alex Chriss, who came over from Intuit. Intuit has been one of the most loved stocks in the stock market over the past few years, and Alex Chriss is really starting to turn PayPal around and get them focused on growth and innovation again. And he's bringing over those important values from Intuit of returning value to shareholders through buybacks, which I really like. This one is between a buy and a hold for me. At the current prices, I think the company is still a buy, and there's still money to be made, even though I'm up 50% on the position. However, since this position is already built out and it's already one of my biggest ones, I'm personally holding. Next up, we have Shopify, which currently has a pretty high forward P of roughly 77. However, this company is still growing revenue at 25% plus per year. And for the earnings they're supposed to report on February 11th, analysts expect 27.5% revenue growth year over year, which is incredible. They've beat revenue and earnings estimates for 9 straight quarters, so you would expect that to continue. This is one of my favorite companies because it's asset light, it's growing incredibly fast, it has a ton of cash on the balance sheet, and they're starting to generate consistent free cash flow, which is also currently growing really quickly. Shopify obviously benefits from the massive trends of commerce shifting to e-commerce, and in my opinion, having tried various e-commerce platform providers, Shopify is the best. The big negative argument with Shopify is the fact that Amazon exists. I think Amazon and Shopify provide completely different experiences and serve different purposes. For most companies and products, both platforms are used. The personalization that Shopify can offer is essential. At the current valuation, I think Shopify is a hold. I'm holding on tight to all my shares and not selling because I believe Shopify has years of growth ahead. And I'm not trying to call the short-term top on this one because I think it may be slightly overvalued. I'm personally cautious buying at these levels, but I'm hoping for any short-term negativity or any dip in the stock price. I'll likely take advantage of a dip if it comes, and hopefully it comes during their next earnings call. Next up, we have SoFi, which currently has a forward PE of roughly 54. Earnings came out, and it seemed like investors were a bit underwhelmed with EPS, so the stock is currently down since earnings. But in my opinion, that's okay because SoFi is basically focusing on growth over earnings right now. The SoFi CEO said in an interview that profitability is there, and while they could drive more dollars to the bottom line, meaning earnings, they don't think that's the right thing to do right now. And I personally agree. I want them to continue to grow revenue and gain more members, which is exactly what they're doing. Let's take a look at a quick video from the CEO in response to the recent earnings that came out last Monday.
Joining us this morning, a first on CNBC interview, SoFi's CEO Anthony Noto. Anthony, great to have you. I guess the tape is a little squirrely today. I wonder what you make of the reaction.
Hey, thanks for having me, Carl. We had a record-breaking quarter in the fourth quarter of 24 and a record-breaking year. Record revenue up 25% year over year for the year and the quarter, over 30% product growth and member growth, also really strong margins and returns. So we continue to focus on durable growth, ensuring that we continue to drive strong returns. And we're doing that through brand building and innovation. The business is the best it's been, and I think the best is yet to come in 2025. We actually not only beat revenue and earnings in the quarter, but we raised 2025 revenue above consensus by about 10%. I think the thing that the market's reacting to is our EPS is slightly below where the street was. And that's primarily because we want to make sure we're investing in the business for the long term and not just driving profitability in the near term. So we're committed to 30% incremental EBITDA margins, which is where we were in 23. 24 was a conservative year in which we drove to GAAP profitability for the first full year, and now we're tilting back more towards investment so that we can grow the top line for this foreseeable future over 20%. We actually took our guidance of the CAGR from 23 to 26 and revenue up relative to before based on that incremental spending. So feel great about the business, a bunch of huge milestones in the year, and we're really happy with the outlook that we have.
We mentioned these originations. Do you think that points to a new chapter in the loan cycle?
There's definitely a more favorable backdrop for lending. We purposely took an approach in 2024 that was conservative and diversified the business. By the end of the year, our technology platform revenue and financial services revenue now accounts for 47% of our total revenue. So we're not a lender anymore. We're much more diversified. And we're also moving the revenue that we're generating to fee-based revenue. In the quarter, we had a record amount of fee-based revenue, up 63% year over year. That will be the growth driver going forward. It was 40% of revenue in the fourth quarter, and we expect it to be the significant majority in the future. So moving away from higher risk, capital intensive lending to fee-based revenue.
Anthony, Leslie Picker here. Good to see you. Within the tech segment, can you shed any light or share any color on what your pipeline looks like with regard to getting more big banks signing up?
Sure. Nice to see you, Leslie. On the tech platform revenue, the business is doing well. We would like to see it grow faster. 2026 will be a year of accelerating growth for revenue based on some deals that we announced today. We announced 3 deals. It's much more broad-based revenue stream, one of which is with the government for direct express benefits that will be integrated in 2026. And we also announced a large financial retail company that will be integrated in 2026. And when it is integrated, will be one of our top 10 revenue producers for the tech platform. And then we announced a deal with a national hotel chain to launch a white label debit card and checking and savings account. The pipeline of demand is very strong. The big financial institutions need to upgrade their technology. They're taking much longer to make those decisions than we anticipated, but we're still fielding many RFPs as well as performing proof of concepts as it relates to the financial institutions. But we don't have to wait around for them to make decisions, as there's other areas for us to drive growth, big consumer brands, B2B, as well as government services.
As you can see, they're really focused on growth right now. And another big positive with SoFi is the fact that they have no physical branches, which can help them by allowing them to focus on new member incentives and sales and marketing and really increase the total members. I started buying this company in 2024 during the summer for around $7 a share, and I'm currently up about 108%. I'm still kicking myself a little bit for not taking more advantage of the opportunity that was literally right in front of me at that time. The growth was already there, and the company just flipped to profitability, so things were starting to look really good. But even at a PE ratio of 54, I think this stock is still a buy, and I'm glad there was a negative reaction after the recent earnings. SoFi grew their members by 34% year over year and now have over 10.1 million members, up from 7.5 million last year. Next up, we have the Cheesecake Factory. The Cheesecake Factory currently has a forward PE of roughly 15, with current growth rates roughly in line with the market, but future growth could look much better with their new restaurant chains, North Italia and Flower Child primarily, expanding across the US. The growth is already seen in the numbers, and management expects both of these chains to expand rapidly across the US in the coming years. If you haven't tried the food at North Italia and Flower Child, please do. They both serve incredible food, and the atmosphere and concepts are very modern and exciting. The company currently pays a dividend of 27 cents per share, which I expect them to increase in the next few quarters. Before they had to shut down all of their restaurants during COVID, they were paying higher dividends. So, again, I expect the dividend to increase over time. The company carries huge debt, obviously, which is kind of expected for a company that needs to lease so many physical locations and is trying to expand new restaurant chains. However, with the margins and free cash flow growth that the Cheesecake Factory can consistently generate, I'm not too worried about that. I believe this company is severely undervalued at a forward P of 15 and is a strong buy. I've been buying this one consistently for many months, regardless of the fact that I'm up more than 50% on my shares. Next up, we have Amazon, which currently has a forward P of roughly 38, but Amazon consistently grows at least twice as fast as the average stock in the market. And in Q4 2023, they showed that if they want to, they can easily generate a ton of free cash flow. They generated almost $28 billion in that single quarter. Amazon obviously invests so heavily in their high growing business segments like AWS, and they're pushing for more market share in advertising and Prime Video and AI infrastructure. So they're spending a ton of money. But with that spend comes more growth. This company will continue to grow for decades to come, in my opinion. They really stay on top of innovation, and they're known for coming in and putting other businesses out of business. And that's a company I want to be invested in. The pharmacy chains are a recent example of that with the launch of Amazon Pharmacy. But anyways, Amazon is a buy. People often argue that it is overvalued at a P ratio of 38 or 35 plus, but you have to realize that Amazon always trades richly, and higher valuations come with companies that hold such dominant market shares in their industries. Next up is ASML. ASML has a forward PE of roughly 29, again with growth outpacing the overall market almost double. ASML is the leader in lithography, which is a crucial step in the semiconductor manufacturing process. ASML holds a monopoly-like position in that market with their extremely advanced and complicated machinery. If you believe in the electrification of our world, which means that all kinds of things will continue to need more and more advanced semiconductors in them, and believe in the continued demand for AI, ASML might be for you. Again, I spoke about ASML in great depth in my previous ASML video, so check that one out if you're interested in learning more about this company. ASML recently faced short-term negativity because of slower demand from consumers, largely due to recent inflation. This company is a buy, in my opinion, during this recent dip, and I think it's only a matter of time until demand picks back up or some positive news or earnings come out, taking this company right back up to all-time highs. ASML reported earnings last week, and they reported $7.1 billion in net bookings, which includes all of their system sales. The news was well received, and the stock already made a small move upwards after earnings. Again, any dip in this company is a buy, in my opinion. Next up is Elf. Elf currently has a forward PE of roughly 23, but this company has been one of the fastest growing companies in the entire market over the last decade. So what's happening with this one? Elf produces the majority of their products in China, so Trump's presidency was seen as a negative for the company with potential tariffs. Also, the company gets a lot of traffic from TikTok through influencers, and with the recent uncertainty around TikTok, that was also seen as a negative for the company. Last week, we finally got the news that Trump will be implementing a 10% additional tariff on China. So this is a tariff on top of any previous tariffs in place. The important thing to note here is the choice of words, until the crisis is alleviated. So this could be temporary. However, regardless of that, I think this is being blown way out of proportion. Elf products are already so cheaply priced compared to other major brands in the industry that they can just pass this tariff or tax onto the consumers, and I bet most people won't even notice. I personally believe this is a buy and saw this recent negativity as a great buying opportunity for a company that is on track to becoming a cosmetics giant. Elf is currently my smallest position, but given the reaction after the tariff news, I will likely be increasing my position this week. And join my Discord link below to get notified immediately when I make these purchases. Next up is Nvidia. Nvidia currently has a forward P of roughly 28, which is incredibly reasonably valued for a company that has been growing as fast as Nvidia. However, their price to sales ratio is high. The divergence in ratios there is caused by Nvidia's incredibly high profit margins due to their dominance in AI GPUs. The market obviously anticipates massive revenue growth, so therefore the P ratio is relatively low. The big worry here with Nvidia is if they can't keep up that growth or experience more competition from their competitors through either better products or more attractive pricing, Nvidia could be forced to lower their prices and therefore shrink profit margins and profitability. I personally believe in AI, autonomous vehicles, and robots, and the continued demand for Nvidia's chips. So therefore, looking at the long term, I believe this company is a buy today given the recent 20% dip. I don't know what the short term will look like. It may be a bit more shaky. We'll just have to see. That being said, I think the company is a buy if you have a long-term outlook. I personally see more growth potential with AMD, and therefore I'll be keeping my Nvidia position roughly a third of what my AMD position. So if my AMD position is roughly $15,000, my Nvidia position should stay around $5,000. Next up, we have Nike. Nike currently has a forward PE of roughly 37. Nike has been facing a lot of negativity recently with the slowing growth of their business. This company was also poorly managed by the previous CEO who chose to emphasize direct-to-consumer selling. This shift led to reduced sales from key partners like Macy's and Foot Locker and a bunch of other retailers. Since the new CEO stepped in October 2024, he has been focusing on getting Nike back to innovation and restoring those key partnerships with retailers who drive so many sales. Nike has been and continues to be the most popular brand among people and teenagers. A lot of brands consistently come and go. Under Armour was around for a while. So was Puma, Reebok, New Balance, and Brooks. Nike always came out on top, and I believe they will continue to do so by fighting off current competition like Hoka and On and Lululemon. I believe this company is a buy. They're facing short-term negativity, but the long-term story remains intact. Nike generates a ton of cash that they use on continuing to sponsor the next generation of athletes. No other company comes close to spending as much on partnerships and sponsorships and marketing as Nike does. That cash is also being used to buy back shares and pay a growing dividend over time. Next, we have Celsius. This one has a forward PE of roughly 28. Just like Elf, Celsius has been one of the best and fastest growing companies in the market over the past decade. Now, again, you may ask yourself, what happened here? Why is this high growth company trading so cheap on a forward PE basis? Well, their growth was a little exaggerated to the upside because they landed a distribution deal with Pepsi, and Pepsi started filling their warehouses with Celsius products, which made it seem like growth was out of this world, and the stock price followed. However, when Pepsi announced that they were trying to reduce their inventory and started holding off on Celsius orders, the true numbers came out. That's why the stock price saw a massive 75% drop in the past 8 months or so. Basically, the stock price rise was stupid, but so is this drop. Pepsi will work through their inventory and start stocking up again soon enough. I don't know if you've noticed when you go to the store, but Celsius's display in stores is only increasing, and they're taking more and more shelf space, which tells you that the product sells. Some stores still don't even sell Celsius, so there's still market share to take as well, so there's more growth opportunity. Celsius is another buy for me. This is another high growth company where I'm taking advantage of the exaggerated dip. Finally, we have AMD, the big one, my biggest position. AMD currently has a forward PE of roughly 25 and saw its stock price drop 45% since the highs of March 2024. This company also faced slowness in demand after the recent COVID stimulus and the inflation that came thereafter. However, this company is just now catching up to the AI GPU game and have their data center segment of the business fully built out. The data center segment showed 122% revenue growth year over year during the last quarter. On top of that growing part of their business, the consumer is starting to get back in a better place after the recent inflation, so the gaming and consumer side of the business is likely to pick back up. If you want my full analysis on AMD, watch my last video. I go deep in depth on AMD and their business model, the future of semiconductors and chips, and their strengths and weaknesses. This stock is a buy in my opinion. It is currently 20% of my portfolio, and I'm down 10% on my position, but I continue to buy regardless. I can't find enough money to continue to buy this one. As I said in my AMD video, AI and advanced semiconductors are really the next wave of technology, and I'm investing heavily in it between AMD, Nvidia, and ASML. I guess I forgot about Uber. I'm not really sure what happened, but anyway, Uber has a forward P of roughly 26 with growth almost as good as Shopify. Yes, you heard that right. Revenue and earnings growth almost as good as Shopify, but trades at a valuation closer to the overall market. So, what's going on here? Obviously, the big worry with Uber is Tesla's robotaxi or full self-driving and Waymo. The belief is that these autonomous vehicle providers will bypass Uber and not partner with them, essentially taking them out of business because they'll be able to provide rides at prices that Uber simply can't compete with. I believe there will be a number of different autonomous vehicle providers in the market, and one of them will tap into Uber's huge network of users. I'm not going to speak too much about Uber in this video, but you can check out my previous video on Uber where I go in depth on my Uber thesis. This company is a buy in my opinion, and I hope they start buying back their shares more aggressively at these low valuations. I'll be paying close attention to Uber's earnings, which come out in 2 days on February 5th. So you can probably see a clear trend in my portfolio. I'm buying a lot of high growth companies that are facing short-term negativity that I believe will be resolved or worked through in the long term. So even while this market is seen as overvalued, I'm looking for those deals and putting my money in those. If you want to hear me talk in depth about any of the videos on this list, let me know in the comments below. That'll be it for this time. See you in the next one.